Okay. Sorry, it's starting to act a little weird today. Here we go. That's much better. You can see me okay?
Yeah.
Okay. Let's do some little talk about banks as a financial institution and how it works. We'll talk about, we'll get through the balance sheet. I'm going to skip right through the basics of banking and then come back to the bank balance sheet very quickly and talk about that. The bank balance sheet is just like any other balance sheet. You had accounting, so you know what the fundamental accounting equation is. Assets equals liabilities plus equity or capital. The thing about a bank, which is different than other types of businesses and different other industries, is that the bank is kind of upside down relative to other businesses. What we think is a liability, you did have accounting, right?
Yeah.
Okay, so you understand that liabilities are debts owed to someone else, whether it's a long-term or short-term, it's a current asset, or current liability, or long-term liability. It's a loan. It's something that's owed to someone else. Well, a loan from the bank's perspective is an asset. That's money that they send out expecting it to come back. That's money owed to the bank versus what is owed, what you owe versus what is owed to you. So the bank is expecting that money. So banks' assets are actually loans. The liabilities, when you put your money in a bank account and on deposit, that is your money, right?
Yeah.
You put money in the account, that's your money. It's not anybody else's but yours. So when you give it to the bank owes that back to you. And because the bank owes you that money, that is a liability from the bank's perspective. You see, that's why it seems a little backwards or upside down, because loans from the bank is an asset, not a liability. So you got to kind of think differently from their perspective. So loans, whether it's a mortgage, or we talked about mortgage industry last week, now from the perspective of the financial institution, that is an asset. So there are other assets that the banks have, okay? But their biggest asset is the loans. And the thing about loans are that the bank, like if you recall way back when I was talking about the Federal Reserve a few weeks ago, and I mentioned that there are 4 tools in the Federal Reserve toolkit: the interest rate, the open market operations, loans, and the required reserve. The required reserve means that the bank, of the total amount of deposits, the bank must have or hold in their vault a certain percentage. Right now it's 10%, really. But that percentage can be changed based on the economy or the trajectory of the economy. And so the banks may change that required reserve. The higher the required reserve, the less money that they have, that a bank has to lend out, means the less money that is going to be in the money supply or in the system, less money that we have access to, businesses have access to. And so as borrowers, so we have less money to borrow, be able to borrow, therefore it will be less spending that has an impact on the GDP. So the amount of loans or that asset side, the assets here are a factor of or a percentage of those deposits. Now, that's a required reserve. Banks can hold excess reserve in the case that they want to reduce lending or have some sort of reserve that is going to offset the or possible defaults and loans. So there's, in addition to the amount of loans, they may have some additional cash or reserves available beyond the required reserves in case of a run on the bank or non-payment of those loans. That's a risk. That's the risk that we measure in the banking system. And the capital is really just the invested money. So this is an example right here of the percentage of commercial banks as of 2016, what they have in checkable deposits, non-transactional deposits. These are all these deposits on the right side, and on the left side are all the assets. The commercial and industrial commercial loans, real estate, consumer loans, other types of loans down at the bottom. And the securities is the reserves are on the top there. That's the required reserves, plus any excess reserves that banks are holding. And then the securities. When the open market operations, when the Federal Reserve sells a bond, banks are the ones that are buying it, and they're buying it and exchanging it for cash. When the Federal Reserve buys a loan, then they're exchanging it for cash. So that goes into the reserve section, that amount of cash. But the securities, the government and agencies, that security section here, the securities I'm referring to are the federal bonds that the Federal Reserve, not the government, but the Federal Reserve buys and sells amongst its member banks. That's that public. So when the Federal Reserve buys a bond, that goes into cash, which is part of the reserves, because it's over reserves. Let me give you an example. Let me give you an example here. I'm going to do a little drawing here to better understand what I'm saying. Maybe it will help. I don't know. We'll see. Let's see what. So we have the assets over here, the liabilities and capital on this side. All right. So this bank, let's pretend this bank has 100,000 in deposits. The required reserve is 10%. So the required reserve is equal to 10% of that. So that means that they have to hold back $10,000 in required reserve. With me?
Yes.
With me so far? Excess reserve, I'm going to put ER, is an additional 8K. Okay? So in total reserves, they have $18,000 in reserves, right?
Yeah.
This we're going to call cash and reserves. We still have 100,000 left over, and forget about capital for a moment. So let's just forget about the capital side just a moment and pretend there isn't one. So what does that mean in as far as loans are concerned? How much loans can the bank actually lend out? Well, they can start off with 90, but because of this 8, there's loans in the available loans is equal to $92,000. Right?
Yeah.
Okay, so far and now we're in balance, right? 100 on this side, 100 on this side.
Shouldn't it be like 82?
Yes, 82. Yes, sorry. Yes, 82. Sorry about that.
I'm sorry.
I should write my 8 even better. 82. Yes, thank you. 82. So far, so good, right?
Yeah.
That's the maximum. This is not this loan, but this bank can potentially lend out $82,000, even holding $8,000 in excess reserves and complying with the Federal Reserve by holding 10. So the total amount of reserves are 18, excuse me, 18. Now, the Federal Reserve, they are in the, they want to, they're going to sell bonds, right? So if they sell bonds, that means they have to, they're going to get cash, means that we, the bank, are going to buy that. So from the Federal Reserve's perspective, it's an open market sale. They're selling a bond in exchange for money. With me?
Yeah.
Okay. So this bank is going to buy one bond for $10,000. Okay. So I'm going to put security here.
REYES.
Now, obviously, we're out of balance, right?
Yeah.
So the bank is going to have to do one of three things. We can't get rid of this. The bank cannot reduce its required reserve, so it has to have 10,000. So it can only do this. It can do this, get rid of this 8, and we still have 2,000 left over, right?
Yeah.
And then reduce this to 80, right? And we're still balanced, right?
Yeah.
But that leaves the bank a little more exposed because it only has this much in reserve, the required reserve, not the excess reserve. And now it has less available to lend out, right?
Yeah.
Okay. The other option they could do is, instead of getting rid of this, I'm going to put it back in.
All right. Can I changed my mind. Instead of my.
And this will have to become right? And I'm still in balance.
RIA.
Yeah.
But notice that we've reduced our loanable, the funds that are available for lending out. They haven't lent anything. This is what's available, $10,000. By doing that, we have reduced the availability of loans. So we've contracted so less people can borrow, right?
Mm-hmm.
Less people can borrow. And it's still the savers. Savers are still protected.
All right. Thank you.
Meaning that their deposits are still over here.
All right.
And that's fine. The savers are there. We're talking about the borrowers here. The borrowers now, instead of having 90,000, they only have 72,000, which is about $28,000 of funds they could have had. I'm sorry. That's $18,000 of funds they have no availability. They don't have, because we're holding on to our 18,000 reserve, right? Not 28. That's actually $28,000 they can't access.
All right.
But there's $18,000 that just got lost because of this 10,000. With me?
Yeah.
You understand what I'm saying? So that's an open market sale. An open market sale is a contractionary monetary policy. It's contracting the money supply, and here's how it looks. This is where it contracts. It's contracting the available loans, which means fewer people are going to borrow, which means fewer people are going to spend, because borrowers are spenders. You got savers and lenders, and we have borrowers and spenders. The borrowers are going to spend the money, right?
Yeah.
Think about this. If you were borrowing money, Juliana, what are you going to do with that money?
Spend it.
You're going to spend it on something. Either you're buying a car, that's spending, or a house, that's spending, or credit cards, that's still spending.
Yeah.
Even if you took the money and put it in the bank, which is kind of silly because you're not going to get as much interest putting it in the bank that you have to pay for it, but someone else is going to borrow that money then. That just increases the deposits, but it also increases the amount of lending we have. So you're borrowing money just to spend it. That's spending. Now, if there was an open market purchase and the federal and this bank decides to sell its bond back to the Federal Reserve, then the securities line goes away, and this goes back up to the 82. Got it? And we're still in balance.
Yeah.
And that's where the money supply is just increased by 10,000 on this case. That's the role of the securities line in the balance sheet we just looked at. See up here?
Yeah. Okay.
So that's where this U.S. government and agency securities, the state, local government, and other types of securities are just other investing or purchases of other types of assets the bank is doing for its own reason, but has nothing to do with the money supply. The government, U.S. government bonds here, the 14 trillion. This is in percent. The 14% here is the significant number you want to see. Okay?
Yeah.
So we have the checkable deposits. That's the checking accounts. More fancy term, checkable deposits. Money market deposits. Those are just it's like a savings. It's a hybrid between a savings and a checking, meaning that you can write a certain amount of checks against that account, but it earns interest. Don't worry about these non-transaction deposits or other savings accounts and really it's the CDs, the certificate of deposits. We didn't talk about it in my little example, but in addition to that liability, if there was capital, that actually increases the numbers in the asset side even more. Meaning, meaning that if this bank had also 10,000, oh my goodness, 10,000 in capital, that puts we're out of balance. So that means that we can increase this even more to 92,000, right?
Yeah.
Conceivably, because there's invested money and the deposits. In any form, whether it's checking deposits or those non-transaction deposits that we saw, the CDs, either one, it still works out the same because they can still lend out anything that's in deposit is free game for the bank to lend out. Maximum. In this case, its maximum amount is $92,000 when I added that capital in there. And so you understand the reserves, excess reserves. We talked about that. Cash in process of collection. Talked about the securities. Well, let's talk about the basics of banking, and then we'll call it for today. Okay?
All right.
The bank, another way of thinking about what a bank is doing is really what we could call an asset transformation. Meaning that they go from an asset, your asset, to a liability to another asset. Meaning your deposits, which is your asset, becomes the liability for the bank. Then they turn around and take your deposits, and a portion of that is lent out, and it's an asset to them. So it's borrow short, lend long in far as maturity is concerned, meaning they're borrowing your money to lend out to somebody else, which conceivably could be you. You can put money in a bank and then go and borrow money from the bank. So here, this next several slides is examples of what I just put on the board. You deposit $100, it becomes cash in process of collection. It adds to the reserves. But if there's a 10%, this case, there's a 10, in this example, there's a 10% required reserves. So $10 is held in reserve, which means that $90 is available to lend out. See, it loans $90. The bank is primary concerns are liquidity management, ensuring that they have sufficient cash on hand. Asset management, from their perspective, it's managing those loans in your stead, because you, as a depositor, are actually partnering with your financial institution, your bank, to lend money out. That's how you get a portion of that interest back on your deposits. The interest paid on your deposits, your savings, money market, CDs, that interest is a portion of what is collected with the mortgage or the loan payments. The loan is charged at a higher interest rate because that's how the bank makes its money, kind of. That's the old adage, is that the interest is how banks make their money. Actually, banks sell those loans, and that's how they make their money back. So they take that sold loan and the money from the sold loan, the proceeds, and then lend that out again and again and again. Managing credit risk, managing interest rate risk. The interest rate risk is what is being that the banks currently are exposed to because they have fixed rates out there at 3%. I don't know if we recall back in the Great Recession, just after the Great Recession, with interest rates so low, we maintained a very, 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 very low interest rate for mortgages. And inflation was 2 to 2.5%. So you're seeing interest rates of 3 to 4% on mortgages. These are long-term mortgages, 15, 20, 30-year terms. But what the interest rate risk is that inflation goes higher than expected, and expectations are so much, and the nominal risk rates aren't increasing at the same rate. So real interest rates are in the negative right now. Even though banks have started, mortgage rates have started to go up, they're still on the negative because of the high inflation. Even though inflation has come down, in October, it was considered 7.1 or 7.7, something like that. It was above 7%, whereas in September, it was 8.1, almost 8.2. And so it's coming down, but we still have, if you have a loan for 4%, you're making money because you're paying 4%, but you're receiving, or your borrowers are making money because they borrowed at the nominal value of the original and paying with nominal money, but the nominal money is devalued by inflation. So you're actually paying with real money, with nominal money, today's money, but it's not equal in value because of inflation to what you borrowed in the first place. Liability management and managing capital adequacy. Those are all very important. We'll focus on credit risk and interest rate risk. So liquidity management is, again, ensuring that you have sufficient reserves for when these depositors start coming back and want their money back. Excess reserves in this case is there's 10% required reserves plus a 10% 10 million excess reserves, so you have 20 million in total reserves. If depositors want 10 million, we still are good. Deposit outflow versus inflow. If we're outflowing $10 million, we have still $10 million in excess reserves. So we're good for a couple of days, but then we have to build it up. With no excess reserves, the bank will have a shortfall very soon because there's not enough required reserves and there's no excess reserves. So how can a bank recover from a situation where even though they have excess reserves, even the excess reserves have been depleted? They borrow from other banks, borrow from the Fed. Borrowing from other banks is what's called the discount rate set by the, is the federal funds rate, which is set, a target rate is set by the Federal Reserve. And the borrowing from the Federal Reserve is called a discount rate, which is absolutely set by the Federal Reserve. So both are the federal funds rate is a rate that has its own market based on the amount of reserves that the Federal Reserve is holding. So the more reserves it's holding, the lower the rate it is. And also its target rate, meaning that there's a price floor. That's what I'm trying to say. A price floor that the Federal Reserve determines how much. The federal funds rate cannot be lower than this amount. It can be higher, but it can't be lower. So even if there's more reserves that which would normally under normal unregulated market would have pushed that interest rate even further, it's going to stop at that price floor for interest rates. Reducing loan portfolio means that they're going to collect loans but not reloan anything of that money. They're just going to put that in reserves. And they could sell securities. I showed you how selling securities can increase the amount of loans, but we could have also taken that $10,000 and put it in with reserves and not increase the loans, but put it in reserves, which was happening when the QE, the quantitative easement, was going on, and from 2009 forward, actually didn't stop. The Federal Reserve had not stopped its quantitative easement officially until January of 21. Excuse me. And it was January 27th, I think, when they announced that they were going to start reducing their balance sheet and reducing the amount of securities they're holding. So in my example here, the Federal Reserve bought this because it was an open market purchase. They bought this. Instead of putting it inside here and becoming 92,000, sorry, let me stand over here. Instead of, oops, a little bit too much. There. Instead of taking this 10,000 and putting it into 92, they could have put it up in here as excess reserves to anticipation of people withdrawing money. So that's where I'm going to stop today.
Okay.
Okay. We'll continue on Thursday. We stop the recording.